Welcome to another time to do business. 55 minutes of current and relevant business conversations. That's what we do here on Business Morning, and that's what we're doing today. We're starting as usual from the global oil space, where prices inch lower again, and that extends the previous session's declines. As investors are assessing the US-Iran peace deal, though uncertainty over the full resumption of shipping through the Strait of Hormuz is limited, and that is falling even further. So for this morning, we see almost 1% in the red. Here's what we have for Brent. Yes, it's gone from 90 to 80, and now it's $78.21 a barrel. And I'm sure with the announcement from Dangote for us here in Nigeria, it's a celebration, but not so much for the government that has been enjoying increase in revenue. WTI is also down, of course, 1.16% at $75.17 a barrel. Both benchmarks fell about 5% for a second straight session yesterday to stand at 3 months low, on hopes that a US-Iran deal would allow oil flows through the strait, and perhaps eventually things will become normal. Let's head to the markets, and we see that it's still a lot of profit taking going on there. 0.5% down is what we saw at the close of trade for the oil share here, 241,984.80. Market cap lost again, 782 billion naira. Volume and deals in the red, just value was able to keep it up in the green color at the close of trade yesterday. Top trades, top gainers first: Cornell, Prestige, and Nimes. Interestingly, we have a founder of Nimes who will be joining us on the program today. And then top losers, we have Jeans, Vitafoam, and Austin Last. Top trades, we have Sterling NG, UACN, and HOLDCo. So UACN has been a bit quiet, you know, after that acquisition of Chivita and all of that. But we see them back here now at the top trades at the close of trade yesterday. HOLDCo is also still in the eye of a lot of investors, but still struggling to recover the 25 naira per share mark, which seems to be a level that we have come to know them for. It's still there. So that's the market. And then one thing that may affect the market is what the central bank has been talking about. The Central Bank of Nigeria is proposing an overhaul of the financial holding company, that's the HOLDCo framework, which could trigger fresh capital raising by major banking groups. It could force structural reorganization by some lenders and significantly alter the economics of financial services industry. According to them, the proposed rules currently open for stakeholder comments, and which is why we'll be discussing it this morning, could leave all 4 existing Tier 1 bank HOLDCos, GTCo, Access Holdings, First HOLDCo, and Stanbic IBTC Holdings. It could leave them below the new capital threshold. We know the banking sector just went through a recap, and it could create an estimated aggregate capital shortfall of about 370 billion naira. That's what they are saying. The investment firm notes that under the current framework introduced in 2014, HOLDCos are only required to maintain paid-in capital equivalent to the aggregate capital of their subsidiaries. However, the revised draft raises the threshold substantially by requiring HOLDCos to maintain capital that exceeds the combined paid-in capital of all subsidiaries by at least 20%. I will be having that conversation right now with Mr. Oji Udemezue. He's the Managing Consultant and Chief Executive Officer of Flame Academy and Consulting Limited, our go-to man for banking issues. Mr. Udemezue, good morning. Welcome to the program.
Good morning, Ini. Can you hear me?
Yes, I can hear you, Mr. Udemezue.
Okay.
Yeah.
Thanks for inviting me. So let's go on with the conversation on this very strategic and important policy in the banking sector in Nigeria.
Yeah, so please, first of all, help us to understand what all of this is about. We know that most of the tier one, the fugas, their HOLDCos. And now we have this coming in and the possibility of them going below the required capital. Help us to understand this and why the CBN is even considering, this in the first place.
Okay, first of all, the HOLDCos are not below the capital requirement, required in the banking sector in Nigeria. Remember that CBN just moved the capital requirement for banks in different categories, that's commercial banking categories, from 10 billion for regional banking to 50 billion, and then from 25 billion to 200 billion for national license. And can you hear me? My network looks like...
Please, go ahead, Mr. Demezu, I can hear you. Go ahead.
And then from 50 billion national license, international license, to now 500 billion. And the central bank had announced that apart from one or two banks, who are not even among the tier one, all banks in Nigeria have met this new capital requirement. So the HOLDCo regulation is a different ball game altogether. And the central bank, in their wisdom, in my view, is trying to be proactive to reposition the banking sector in Nigeria, to that point where, risks are separated among different entities. First and foremost, let me remind you that some time ago, Nigerian banks were owned by largely individuals who were known as the founders and who almost sat tight as the MDs of these banks until early 2000, when a new governance requirement came up that no MD will serve more than 2 tenures of 5 years each. And that became a concern to most bank promoters and founders and owners. But then the central bank, in their wisdom, had to implement that so that the very big names we used to know in the industry had to serve out their tenure and hand over to the next person and next person. So the idea of that is to ensure that banks are not under the full control of an individual person or family, such that decisions taken in lending and all of those things will center around one person. Just a corporate governance. Because banking business is very delicate and risky. A bank is given the license to collect money that belongs to several members of the economy. And when these monies are mismanaged, the bank will not just go down, but the people will lose their deposits, and the economy, most importantly, will suffer a big crisis. So, to de-risk the sector, central bank insisted that one individual will not run the bank forever. But these persons should serve their tenure and hand over. That brought about a new corporate governance system. And later on, they also found that, even though people left the system, they also control the system one way or the other. And then the new rule came in 2014 that, after the banking license was no more a universal license, where a bank will be doing insurance, asset management, stock market activities, pension, and so on. The license was now, how do I put it, divided into different activities. If you're running a commercial bank, better run commercial banking. If you want to do pension, insurance, asset management, do them separately. But if you so wish now, you can form a company known as a financial holding company who could just be an umbrella, covering a number of financial services activities that you have interest in, whether it's pension, insurance, mortgage business, other subsidiary activities that relate to financial, even fintech and so on. So that you can be a bank, and then be doing these things, but you can be a bank under a holding company and then now have other activities that go on, all also hiding under the holding company. That's the nature of the HOLDCo we have. And these HOLDCos, that's the holding companies, are not meant to be operational. They're not meant to run activities like, banking or something. They are meant to be coordinators, providing board and governance, corporate philosophy and all of that, whereby the subsidiary institutions under them would not be the ones operating their various businesses supervised by the board under the HOLDCo. But I think the central bank, in their wisdom, is also seeing a situation whereby even the individuals, we have said, run your own tenure and hand over, they stay at the HOLDCo and still almost operate these individual units of the HOLDCo. So this whole policy is about accountability, governance, and better management of risk in these entities. And as we go further, I will explain the implications of the rules in the ring fencing being promoted by this policy.
Yeah, because I think you should just go ahead, Mr. Demezu, because there are fears that is going to, I mean, that's one of the things that I saw, that it's going to put them, it's going to need for the HOLDCos to go for a fresh round of capital sourcing. That's one of the fears.
Okay, now let me explain the capital part. From my understanding of this, by the way, it's an exposure draft, which they're still working on, and I believe that the central bank will still meet with the governors forum. I mean, the MDs forum, where the governor and the MDs of banks are always in constant communion and discussions. The thing about capital is that central bank is trying to say that if we must continue to have a HOLDCo system, then we demand that the HOLDCo will bring up more capital to protect the whole group from risks that may fly from different risky activities. Fintech, for example, and asset management may have different risk nature compared to banking, maybe retail banking or commercial banking. And if you're a HOLDCo holding businesses among all these sectors, even across borders, you have a HOLDCo that owns a bank, and that bank is in many cities in Africa. Nigerian banks are doing very well, actually, in the banking sector in Africa, sending investment across East Africa, West Africa, and even now Southern Africa is coming up. I think it's only in North Africa that we don't have so much activity. So as Nigerian banks are growing, they are putting their hands into various country risks, risks that are outside the country. And central bank is saying we need to protect our depositors and investors, so that risks that flow from these, other investments in different sectors and risky countries will not impact heavily on, depositors and investors in Nigeria. So what they're saying here is that when you combine your minimum capital in all of these entities you are holding, whether a pension business, insurance business, fintech business, with different risk profiles, when you sum the minimum capital requirement, including the banking franchise, by the way, when you sum the capital together, we now need you to have a capital in the HOLDCo that is not just equal or more than the total capital put together, but at least 20% higher than this capital. If a bank has a capital base of 500 billion, for example, insurance 50 billion, maybe asset management business 50 billion, in that HOLDCo, total capital is what? 600 billion. They are saying, please provide an extra 20%, that's 120 billion, making your total capital 720. This is more like, when you have a dam, you want to make a dam stronger so that when the water hits the dam, it will not easily overflow and cause the damages. So raise your dam a bit. That's actually the idea of economic capital, different from regulatory capital. But because CBN has seen that many banks are merely trying to, keep to regulatory capital, that's minimum capital requirement by regulators to enable you to run your business, the idea of economic capital is not being very much thought about by these banks. Economic capital says, despite the minimum regulatory requirement of capital in your business, you yourself should know the different businesses you do more than the central bank. You should be able to assess the risks you suffer in different sectors and different borders or countries, and be able to come up with an economic capital bigger than the regulatory capital that can shield you from risk. That's the idea of banks submitting what you call ICAP, Internal Capital Adequacy Assessment Procedure, whereby the bank speak to themselves and the truth about their risk and provide more capital than required by central bank. But what we have seen over here is that banks are merely struggling. Not all of them, though. Some have kept a decent margin above the minimum capital requirement, which is currently 15% for all the internationally active banks, and then for systemic important banks, that's domestic systemically important banks, what you call DSIM, they have 16%, 1% above the minimum capital of 15%. Now, banks are struggling to keep to that 16% if they are the fugas, or 15% for other banks, other IABs, internationally active banks. But central bank is saying you should go above that. So instead of allowing banks to come up with their own, personally assessed capital adequacy, they are now making it 20% above regulatory minimum. That's for the HOLDCo. But for individual limits, they can maintain their regulatory capital without any issues. So it requires banks, even though, we are talking about banks here because banks are the major components of this HOLDCo to start with.
Correct.
So you find that these banks have to now raise more capital to support the HOLDCo's capital holding to be above 20%, of the total capital added together.
All right, Mr. Demeze. Mr. Demeze, so yes, we appreciate the fact that the CBN is trying to ensure, that these banks, whether HOLDCos or just the banks, that they have strong foundations that can withstand storms and protect customers' funds. But at the end of the day, I mean, we've seen the recap, and now we may be seeing another round of capital, being raised by the HOLDCos if, from your explanation. But the bottom line is, does this make the credits to consumers, credit to corporate, does it make it more available? How is it affecting the daily operations and businesses of Nigerians, not just, having the capital and getting the numbers and keeping the ledgers, but actually in economic activities? What impacts can we say we have seen after the recap, or can we expect, even if this goes through for the HOLDCos?
Okay, thank you for that question. Allow me give a little more insight on this policy before I answer your question. One insight we need to understand is that HOLDCos are meant to hold the various units, the different units who operate their businesses and then report to the HOLDCo. But Central Bank is now saying that as we have the HOLDCo, the banks in these HOLDCos are also now acting as a HOLDCo of their own, investing in several banks in Africa. But they don't want that anymore. They want the Nigerian bank to report to the HOLDCo just as much as the Kenyan bank, the Ghana bank, the Rwandan bank, who are found in these different countries in the name of, let's say, Access or GT Bank or Zenith. These are banks expanding in Africa. So Central Bank is saying the Zenith Bank Nigeria, for example, or GT Bank Nigeria or UBA Nigeria should report to the HOLDCo just the way UBA or GT Bank or Access Ghana or Kenya and so on should also report to the HOLDCo. Otherwise, they should have an intermediate HOLDCo holding the bank, so that these banks will not be holding the same balance sheet, bundled together with all the subsidiaries, such that a risk in a particular jurisdiction can eat into the books of the Nigerian bank, affecting local investors and depositors. So they want to ring-fence the various members of this HOLDCo. HOLDCo is an umbrella, containing different businesses. So Central Bank wants these businesses to report on equal authority to the HOLDCo. But that's where you have the documentary problem. A place like Rwanda, for example, no bank or no entity can own a bank alone. Every bank in Rwanda is now a public limited liability company. It must be held by the public. So a Nigerian bank, for example, owning a bank in Rwanda must involve other owners. That's their own way of trying to de-risk banks from individual governance and not proper corporate governance. So according to your question now, when these things are eventually done, of course, CBN needs to give their support, documentary approval, and all of the support they need, so that these banks can successfully, carry out these instructions in various jurisdictions. It's not going to be easy, but it can be done. In terms of the advantage to lending to the economy, the key thing here is that the more capital banks raise, just like we have seen, in the recent capital raising, the more the bank develop the appetite to give more loans, because their risk capacity has just increased. But that's where also the concern is about risk. If you have increased your capital, for you to give good account of the capital to the owners of this capital, that is return on earnings, return on equity, return on investment, for it to improve or stay at the pre-capital raising level, you must compulsorily do higher business, make more profit and so on. And to do that, the primary business banks do to make money is lending. So we expect to see this activity or this regulation, dovetail into more lending by commercial banks, not just in Nigeria, but within Africa.
But also, Mr. Demes, we're considering the cost of funding, the interest rates. That's still a consideration.
The interest rate in Nigeria is a crazy one because there are several regulations around lending that force lending rates in Nigeria to be crazy. Like, when a Nigerian bank collects 100 billion for a customer, you have to keep 45 billion in central bank in CRR, cash reserve requirement. You can't do business with that. And you also have to keep another 30% in liquidity ratio requirement. So these funds are sterilized. And in economics, the loanable fund theory, the amount of fund from a deposit you can actually loan with in Nigeria is barely 25%. Even though some of us No, there are other ways that banks are allowed by central bank to improve their loan-to-deposit ratio. But as it is, when you look at the cost of CRR and cost of LRR, banks are struggling to lend even at below 40%. In Rwanda, where I am currently, I'm actually running a training for a bank in Rwanda. The current lending rate in Rwanda is about 15-16%. In Kenya, it's also around 14-15%. These rates are close to single digit, as you would desire in Nigeria. But far from it, because in Rwanda, the CRR is 5%, is 20%, which is actually not emphasized that much. So 5% sterilization is enough for you to lend at a low rate. But when central bank sterilizes your deposit at 45% CRR and 30% LRR, you only struggle to break even and maintain your cost of operation. So the policy of government in managing inflation has to reflect this. And meanwhile, while we tighten monetary policy by increasing CRR, inflation is not responding, showing you that our inflation is not demand pull, but cost push. So we have to look at medium to long term, how we can produce our own goods, import less of petroleum and other products to ultimately deal with inflation. Our horrible, or how would I say, very aggressive fight against inflation using demand pull measures is costing us, bad economy, because as you increase this rate, borrowers borrow at a very exorbitant rate, making them non-competitive among China and other producers. And that's a big problem. When monetary policy is trying to tighten control inflation, it's causing business damage because manufacturers and factories borrow at a high rate, combined with poor energy supply, high cost of doing business, and so on, making our economy less competitive and making it almost impossible to achieve our double-digit growth in our GDP. These issues are complicated, but we hope that central bank, in their wisdom, will manage and coordinate these policies so that we don't have only a good lending rate, increased lending, but in the appropriate manner and terms and conditions.
All right. Thank you so much, Mr. Ojideme, Managing Consultant and Chief Executive Officer of Flame Academy and Consulting Limited. Thank you for your time and sharing your perspective.
We haven't done enough on this topic, but maybe next time we engage again. Thank you for inviting me.
Thank you.
All the best.
All right, now let's take a break. When we come back, the Pearl Awards Nigeria Corporate Summit celebrate 30 years and also discuss the reforms. Who's not discussing the reforms now? We'll have an elaborate conversation on that after the break. Please stay with us. Welcome back. Still watching Business Morning here on Channels Television. Pearls Award Nigeria celebrates 30 years of existence at its 2026 Corporate Summit. The body attributes its sustenance to the caliber of the board members and commitment to fairness for all, which it prioritizes in its dealings and decision-making. Beyond the celebration, it was a time to discuss the impact of the country's economic reforms on corporate competitiveness. After discussing Built to Last in 2025, Pearl Awards Corporate Summit joins recent conversation with the theme Policy Reform and Corporate Competitiveness, Navigating Towards a Sustainable Edge, as it gathers stakeholders in Nigeria's capital market alongside regulators for the 2026 event.
The central question before us today is therefore not whether reforms are necessary, but how businesses can successfully navigate reform-driven environment while building sustainable competitive advantages that endure over time.
We remain convinced that resilient institutions and competitive enterprises are indispensable to the achievement of Nigeria's long-term economic aspirations.
Investor sentiment is at the heart of considerations, as it's one of the sustainable way for businesses to grow.
Sustainability has become a defining factor in how businesses are assessed globally. Investors increasingly consider not only financial returns, but also the quality of governance, environmental responsibility, and social impact.
For the Governor of Lagos State, Mr. Babajide Sanwo-Olu, represented by the Commissioner of Information, he shares future plans by the government concerning the market.
Very soon, we'll have a food and logistics hub that is big enough to feed the whole of West Africa for at least 5 months. God forbid, should there be drought. So all of these things we will not be able to do without the exchange. Very soon, in a matter of weeks, I'm sure Lagos State government, the process is on, is going to be coming to the exchange again to raise some money.
Then the theme comes alive as the keynote speaker, economist Mr. Bismarck Rawani, dissects the factors and what Nigeria should focus on.
Inequality. And today in Nigeria, we talk about reform and the unexpected, unintended consequences of reform. You find that people the rich are getting richer, and the poor are not getting rich as fast as the rich. And where I come from, we say the poor cannot sleep because they are hungry, and the rich cannot sleep because the poor are awake.
The panel takes the conversation further.
We've democratized access to the market. Today, everybody in the market is consuming an API. Whether you want to connect from the registrar to the investors, from CSCS to SD, those, class of companies are also emerging. You understand that they are providing some of these services because it's not the NGX nor CSCS that is providing. What we provide is an API.
You cannot say that the reform has worked as intended if it does not meet the last mile.
The SEC has currently ongoing the regulatory incubation program, the accelerated regulatory incubation program, because we recognize that whether or not you bring these people into regulation, they will do business. So for digital asset service providers, virtual asset service providers, and people in the digital space or the AI space, like you're calling it, we're saying, you know what, if you have already begun business, let's see your model.
The corporate summit ends with awards to deserving participants.
Congratulations.
Well, staying on that and the conversation which started there, and one of the participants there joins us this morning, Dr. Samuel Hamboa, the founder and former Chief Executive Officer of Nimed Pharmaceutical. Thank you so much, sir, for joining us on the program this morning.
Thank you, Nate. My pleasure. Good morning, Nigerians.
It was good to see you yesterday at the event, at least physically, and the discussion about, the reforms. Let me start with what Mr. Bismarck Rawani said, the unintended consequences of reforms, where the poor cannot sleep because they are hungry, but the rich can also not sleep because the poor is not sleeping. And this we can tie around the reforms. Let me get your reaction to that first.
Well, I think Bismarck is just trying to state the matter as it is, because this is the challenge we have. The challenge we have is that policymakers at some level somehow are distant from the impact of the policies they make. They take the sound bites and they do not drill down. For all we know, we've done wonderfully well in macroeconomic reforms. We've done wonderfully well in increasing our capacity to earn revenue. Before 2023 or 2024, Nigeria had two crises. We had a revenue crisis and we had an expenditure crisis. Now we have seemed to have reasonably dealt with revenue crisis through subsidy removal, through foreign exchange normalization, or equilibrium, as you call it. And we're increasing tax. Tax to GDP is increasing in Nigeria. Those are helping us to increase our revenue. But because we've not balanced it with appropriate control of expenditure, we are seeing that the impact of that reform is not trickling down as fast as we can. So while some people are upstairs who are in some sectors that are able to see the impact immediately, many of those down are yet to see. What they are seeing is greater taxation. what I've seen is greater influsion of resources from their pockets to other governments or to other people. Of course, both globally incited inflation and the one that came from our own reforms have worsened the purchasing power of the consumer. So the consumer is weeping while our pockets as a nation may be growing. And so that's what brings the dichotomy which Bismarck spoke about, the rich who are in the upper echelons, who are able to see the impact of the reform, are getting money. Stock exchange is booming. People are cashing out, so much. But the ordinary folks on the street are spending more money purchasing electricity. They are spending more money purchasing transportation. They are spending more money buying basic food. So nothing else is coming. There's no compensation yet. This is why that dichotomy exists in it.
Where should we look for this compensation? I know that I remember the Article 4 of the IMF and the reaction of the Minister of Finance and Coordinating Minister of the Economy also talked about poverty. And then the minister had promised that those welfare packages, they will keep it coming. So could we say that is where to connect this gap that seems to be growing between the rich and the poor?
That welfare package is not sustainable. It's not what will bridge the gap. It could give a temporary relief, but then after eating your bread this morning, they give you a loaf of bread. You try to eat this morning, tomorrow morning. The day after, there's no more bread. So I think what we should be pursuing is how do we create a large opportunity for Nigerians to be engaged productively? How do more the average Nigerian young man get employment? How does the average farmer have greater access to his inputs? And then when he manages, that is if the bandits and the herdsmen who are armed allow him to produce his crops, that he can take them to market and sell before they get spoiled, and he can get an economic revenue that will pay off the cost of putting the farm together, watching over the farm, hiring security men to look at his farm, and then moving the goods to the marketplace. So what we need to do is to improve the operating environment, de-risk the environment, remove the cost that the average person is carrying in the basic things of life. That way, he will have a little bit more money in his pocket from his struggle, and he can then see an improvement in his life. So improve the environment, remove the unnecessary costs. Then the other thing we need to do is also to improve the cost of service delivery. As I said in my opening, we have reformed opportunities to get income. We've not quite focused on the opportunity to optimize that income. Today, there's still a lot of leakage. Bismarck calls it leakage. It is more than a leakage. What we are seeing in some cases is that you're pouring water into a basket, and then the basket has holes. And no matter the effort of government, tax this, borrow from here, do this. If the bucket is leaking, if the basket is leaking, we will continue to struggle, increase tax rate, increase this, squeeze here. You're squeezing the same guy. Meanwhile, there are rats and all kinds of rodents and all kinds of vermins. We are sucking from the bottom. Can we do the reform to close those gaps? Can we go back to the public service reform, which Orange proposed several decades ago, and nobody has paid attention? Let's streamline government. Instead, we're expanding. We're creating more ministries, creating all manner of opportunities for government overhead expenditure to keep increasing. And then when you're spending so much money serving the bureaucracy, we cannot finish the roads on time. We cannot finish the bridges. We also cannot provide sufficient security to protect the people. We cannot provide enough electricity at affordable prices. Neither can we even provide water. All Nigerians now live on pure water and bottled water. Hardly do you get water from the tap, and each of these you pay. So we need to improve first, remove the erosion. There's more money left, which government can invest, and that investment will bring, some reduction in the price that the people pay for common things like transportation, because the prices are beyond them. So if they earn more by improving the environment, helping to reduce the cost of electricity and all other things for the small and medium scale small scale companies that are producing, which is where most Nigerians are in, then the SME cluster. So we must reduce the cost of electricity, provide water, provide road, reduce the cost of paying for security. We are paying neighborhood, we are paying area, we are paying state, we are paying all manner of fees for security in Nigeria today, because if generals can be abducted with their wives, I do not know who will not be afraid. If a general, who even when they are out of the office, they have their ADCs or oddly still carrying arms around them. So there is so much everybody is doing, and if you don't, it's like if you are taking a risk for your life. And when people do all that, then it leaves little money to buy food. It leaves little money to buy the essentials of life, and then people feel that way. So let there be more employment, reduce cost of governance, that will bring down cost of service delivery. So we need reforms, and I've been crying on this all this couple of years. We've done well in improving our income. Can we stop? Why should we be having the bloated government we have? Why should we have bloated bureaucracy? Why should the National Assembly still be bicameral and they add no value? There should be one National Assembly, so that reduce the number of ministries, merge those who can be more efficient. We have technology. Technology should accelerate service delivery and take away unnecessary overhead or duplications. Like somebody was speaking in one of your programs today, every problem will set up a new agency, and every agency has chairman, has a council, has board. Every little thing, we have a new agency with a full paraphernalia of offices. We buy them cars at 150 million for the smallest cars you can buy. How can the poor man survive? How can he get a benefit? No matter how much government, you can tax us till Jesus comes and there's no blood left in us. If the efficiency of government does not improve, efficiency of service delivery, if we do not block the leakages, which are becoming, using the word of orgy, just it's like a dam being broken now. It's not just leakages. So we need to focus on that. I believe that maybe it's not possible for government to do all at once. So they focus on income, revenue, acceleration. My challenge is it's time now for us to become more efficient. Take away, fight corruption. Nobody, corruption is hardly mentioned these days in Nigeria. It's taking that's a lost cause, because the endemic corruption in Nigeria is affecting everything. When we come to the television and make beautiful announcements of programs and progress, and even talk of figures. Somebody will say we spent 3 trillion here. Somebody will say, and I'm laughing, I say, where is the output? Where is the cost-benefit analysis? Where is the justification for that kind of expenditure? Is it just throwing money around?
But Dr. Habua, these things you have said, even government officials would say the same thing. We need to block the leakages, bloated government expenditure. But who will bail the cat? Where do we start from? The
government will bail the cat. We have a president who is acclaimed to him, he applied for the job. Nobody, people like him, they are still fighting to stay in the job. With all the problem we are facing, I would think that people should run away from the job. But but they are fighting tooth and nail, ensuring that they get the job by any all means. Then do the job. It's as simple as that. If you can't do the job, then get out of the seat. Let other people who are willing and are ready to make the sacrifice. This job does not call for comfort. There's no place for comfort. Anybody who has changed to change Nigeria must be prepared even to die if need come. Get the job done. Don't fear nobody. Fight security. If they kill you, well, that's part of the risk and part of the sacrifice. This country needs people who are fearless, who do not care about their own self-being, who must be self-sacrificing with their team. We need to get that team that is ready to die to change Nigeria. Until that happens, we're just scratching the surface, because the story we're saying now, the story we told 10 years ago, 15 years ago, in the Nigeria Economic Summit Group, which we started in 1993. There's nothing we have said that we are not saying now. Everything I've just said now, go to our report for Summit 1 or 2. You see the same. Some things have been done. I accept that. The reforms that have been done have been helpful. I would say liberalize the economy, open it up. That we agree, because investments need to come. We need to improve the environment to make Nigeria attractive, both for local investors and for international investors. But we must improve the image of our country. Nigeria is still regarded as an endemically corrupt nation. Until we change that, and it is in the hands of government, from governor to prime minister to ministers to president to chairman of LGS to chairman of institutions. Nigeria, you get a government job, it is bazaar. It's an opportunity to make money. Somebody is struggling with us in the private sector, but the moment he becomes a government official, his life changes. And those of us still in the private sector were where we were. Why should it be so? Public sector should be a place for sacrifice. Leave the comfort of your private sector and then go to make sacrifice in the public sector, not the other way around. This is the fundamental paradigm that must change. Otherwise, we will be in this situation for a long time. I'm not cursing us. It's not a cause, but it is the cause-effect relationship. We must get somebody. This is why Nigerians are looking for people who are a little bit more frugal, who can manage our economy better, who can control expenditure. Our problem today is expenditure control, not income. Well, there's enough money we are raising from all we are doing to serve us well. It can go far. Contracts in Nigeria are not value for money contracts. They are over bloated. They do not compete with the rest of the world. What we use 1 kilometer for construct 1 kilometer in Nigeria, you do 20 kilometers elsewhere. And we can give every reason for that. It is the truth, and it is only when we accept the truth that we can be set free.
Well, good enough, sir. Election is around the corner, and the people's vote is supposed to choose, who will be at the head of affairs. So hopefully Nigerians would remember this, the need, the necessity that the country is or needs at this time, and they will put that into their votes as they make their choice. Thank you so much, founder and former chief executive officer of NUMED Pharmaceutical, Dr. Sam Ohabuwa. Thank you for your time, sir.
Thank you. God bless you. Thank you.
Bless you too, sir. All right, now there's the Advanced Senior Executive Course on Strategic Foresight and Trade Intelligence, and it's specially organized for the Nigeria Customs Leadership. It's being carried out by the Bashir Adeniyi Center for International Trade and Investment of the Nigerian Institute of International Affairs. And according to the organizers, this has become very necessary as Nigeria Customs Service occupies a strategic position at the intersection of national security, trade facilitation, revenue generation, and economic development as the country deepens its engagement with regional and global markets through initiatives such as the African Continental Free Trade Area, that's the AFCFTA. Customs leadership must be equipped with the knowledge, tools, and strategic mindset that's required to navigate the future challenges and opportunities. This executive program has been carefully designed to strengthen the capacity of senior customs officers in the areas of strategy foresight, trade intelligence, risk management, customs modernization, technological innovation, and institutional transformation. And it's through expert-led sessions, practical exercises, and strategic simulations, and some study visits.
Yes, the Nigerian Customs Service right now is going through a transformation process. So this training will help the upcoming people to know what it's like to be strategic when it comes to decision makings and when it comes to strategic leadership. It will help the officers in this course to take strategic steps to improve themselves and become better leaders.
There are a lot of uncertainties in global trade landscape. The issues of geopolitical uncertainties, supply chain disruptions, there are climate-related risks, there are a lot of risks, and which is why the customs service all over the world have to be prepared and anticipatory in dealing with these uncertainties that plague the global trade landscape.
It's time for global news, and we head straight to SpaceX. It's the biggest IPO in the world at this time, made the owner the richest, the first trillionaire in dollars. Well, SpaceX has jumped for a third straight day, overtaking Amazon.com in value to become the fifth largest stock in the world. Shares closed at 4.8% higher, pushing its market capitalization to $2.65 trillion. That's roughly $8 billion higher than Amazon's. At the stock's intra-high, the market value of Elon Musk's rocket and AI company topped Microsoft Corporation to briefly become the world's fourth largest stock. Elon Musk, the first trillionaire in the world. I'd like to make a name like that very soon, yeah? Well, away from that, Cathy Wood's ARK Invest has disclosed that it trades showing notable sales of shares in Advanced Micro Devices and Strata Critical Medical. The investment firm sold a combined 23,844 shares of AMD through its ARKF and ARKX exchange-traded funds, with the transaction valued at approximately $13.05 million. The move follows a similar sell-off the previous day, signaling ARK's continued reduction of its stake in the chip maker. ARK also divested 395,646 shares of Strata Critical Medical, spread across its ARKQ and ARKX funds. The sale was valued at about $2.33 million, extending the firm's recent trimming of its position in the medical technology company. And in the United Kingdom, inflation unexpectedly held steady in May, suggesting price pressures were weaker than feared, even before a U.S. deal to end the Iran war sent energy costs tumbling. Consumer prices rose 2.8% compared to a year earlier, unchanged from April. This is according to the Office for National Statistics. It's below economists' expectations for inflation to hit 3%, but the drop is attributed to a change in the UK's regulated energy price cap that was expected to be short-lived. The price cap is due to rise by 13% later this summer, when energy costs will hit a 2-year high. Backtrack a bit and see what's happening in the United States. Our Washington correspondent Maria Bird gives us an overview of trading in yesterday's markets.
The U.S. stock market was mixed on Tuesday, as the Dow Jones was up at 0.6%, continuing on from a Monday rally, and the S&P 500, though, dropped 0.6%, and the heavy tech Nasdaq also dropped at 1.1%, as many investors are watching the U.S.-Iran agreement and waiting to see if this peace deal will come to fruition on Friday, and if this means the Strait of Hormuz will be open by Friday, as this agreement has many wondering how this will have an impact on the U.S. economy. Investors are also very hopeful and wondering how the first meeting with the new Federal Reserve Chairman Kevin Warsh will turn out as the meeting opened on Tuesday and will close on Wednesday, with not much hope that there will be interest rate drops, but there is some concern and questions around the U.S. inflation and whether or not that will be addressed at Wednesday's meeting.
Yes, of course, we're expecting the decision, the first one, I believe, under Mr. Walsh, coming from the United States. And we saw inflation earlier higher for the third straight month from the United States. So it doesn't look like there'll be a lot of movement, but who knows? We'll watch and see. While shares of China's Sensonic Electronics Technology surged in their Hong Kong trading debut today, reflecting strong investor appetite for semiconductor and technology listings in the city's resurgent IPO markets. The wireless sensor chipmaker's stock jumped over 120% to 41 Hong Kong dollar. That's above its initial public offering price of 18.36 Hong Kong dollar. Investors' interest has been fueled by growing enthusiasm for artificial intelligence and semiconductor-related companies. And this helping Hong Kong reclaim its position as one of the world's busiest venues for new listings, despite ongoing geopolitical uncertainties. Well, IPOs ruling the world now. Thank God Nigeria also has its own big IPO expected in September. Of course, that's Dangote Refinery. Now, to Singapore, where the non-oil domestic exports climbed 38.4% in May compared to the same month last year. This is according to government data that was released earlier today. The figure was higher than expectations of 30 and was the biggest rise in the export readings over the past 20 years. Strong demand related to artificial intelligence drove exports of integrated circuit, disk, media products, and personal computers. That's it for Global News and for Business Morning today. Thank you so much for being a part of it. Remember, you can always watch our program at any time on our YouTube channel. You get previous episodes, and I'll be back at 1:30 p.m. to give you an update from the market and other economic stories. I'm Ine John Mekwa.